Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate a consistent return year on year. The first thing you need to do is open up your brokerage platform. The one that I like to use is Tasty Trade, but by all means feel free to use whatever you like. It's all the same stuff. And of course, we're going to be writing or selling these contracts. So we need to know where we are in the option cycle. So we want to just pull up any underlying. We've just got up the micro crude oil futures. We want to look at an equity. Let's just say Netflix. So now we're presented with a list of expirations here. And we've got two types of expirations, weeklies and monthlies. Anything with a orange W is a weekly, and then anything without is a monthly. Sometimes you might see something with an orange Q. That means it's a quarterly, but you don't see that too often. So we want to stick with monthly expirations, not weekly expirations, and we want to be about 30 to 60 days out in time. 45 days would be ideal, but we'll have to see what we can get. So if we go down the list, we've got October 18th. That's the first monthly expiration. That's 8 days out. That is far too close. So we're going to go to the next one down, November 15th, and that is 36 days out in time. That is within the range of 30 to 60 days. And I think it would be perfectly fine to open a trade on November 15th with 36 days left in time. It is a bit on the short end. You are going to get slightly higher gamma, but your theta will be higher as well. You probably won't be able to get to 50% of max profit by 21 days to expiration with 36 days left on the contract. However, this is where intuition comes into it. If you do open a position with 36 days left to go, by all means you might want to hold it until you've got, say, 15 days left to go. I wouldn't recommend holding it all the way to expiration. I don't recommend holding anything to expiration if you're selling monthlies like this far out. But yeah, 36 days is okay. We would like to be a little bit further out, but by all means 36 days is fine. So November 15th, that's the date that we're going for, and we know now 36 days out in time. So we can take this information, come over to our watch list, and we basically want to just filter out everything that has earnings within that time period. And the reason for this is because earnings will have a negative effect on your P&L, right? It will increase volatility, it will mess up your deltas, and this is what we don't want. And it will reflect negatively on our P&L. We also want to filter out anything that has a low liquidity level. And the reason for this is because we want to trade tight spreads and we want to be able to get in and out of positions very easily. And to do that, we need liquidity. So once we've got that done, we're now left with a list of underlyings that don't have earnings over the selected period, and also everything here is liquid. We want to list everything from high to low IVR. The reason for this is because we're going to be writing and selling, or essentially shorting, these contracts onto the market. And so the way we make money is by either buying the contracts at a later date for less than what we sold it for, or the contract's expiring completely worthless and we don't have to buy it back at all. And that's how we would make money by writing options contracts. So volatility contracts 80% of the time in the market, and we want to be on the side of volatility. Volatility is mean reverting. So if volatility is high, we want to sell, because when the contraction happens, that will erode the value of the contract, allowing us to buy it back at a cheaper price. So that's why we've saw everything from high to low IVR. And as you can see here at the top, we've got crude oil. Crude oil is looking very juicy at the moment. We have got a position on crude oil. This is futures, crude oil futures and Australian dollar futures here at the top. We're not going to go over futures today. We're just going to go over normal equities. We've got EEM. We did have a look at this position, a position on EEM recently, so we're not going to go over EEM again. However, IVR is looking very, very nice. Bar. As high as IVR is with bar, it has actually come down quite a lot recently. However, I think there is still a lot of room for contraction with bar and a couple of other Chinese stocks like Baidu, for example. We've got GDXJ here. Let's have a look at GDXJ. Why not? In fact, let's not have a look at GDXJ because the clearing firm actually increased the margin requirements for GDXJ. This was about a week ago without any explanation or reason. So, in fact, let's actually have a look at GDXJ because we did have a video of it, of mocking up a position on GDXJ before the clearing firm made that adjustment. So, it'd be good to get a before and after. So, let's have a look at GDXJ. Obviously, we know we're going to be November 15th, 36 days out in time. So we open that expiration date up, and now we're presented with what's called the options chain. Now, this horizontal orange line shows you where price of GDXJ currently is with respect to the strikes here, and the vertical orange bar shows you what the expected move is of GDXJ over the next 36 days. Now, how do we make money from this? So we need to sell something. And so what are we going to sell and where are we going to sell it? Well, we need to sell one call and one put. Now, we want to sell it outside of the expected move. And the reason for that is because that's going to lead to a high probability of profit for us. That's what we want. So I like to typically sell contracts anywhere between a 15 and 20 delta. So if we go down the delta column here on the call side, we've got an 18 delta, which looks perfect. And then on the put side, we've got a 19 delta, which also looks perfect. So now, as you can see here, we've got an 18 delta contract on the call side and a 19 delta contract on the put side. Essentially, this is creating a range, right? Price is currently within the range, and we want price to basically stay within this range. And for the astute people out there, you will have noticed that our contracts are sitting just outside the expected move. And that's not a coincidence. As long as you go with a 15 and 20 delta, you'll pretty much always be outside of the expected move. And as we can see in the bottom left corner, we've got a probability of profit of 70%. So we wanted a high probability of profit, and that's exactly what we've got by being outside of the expected move. And if we wanted to close this position at 50% of max profit, then we've got an 85% chance of that happening at some point over the next 36 days. So very, very high probabilities. Now, what actually is this position? Let's visualize it on the chart. So where would our price levels be? Our price levels would be at the strikes where our contracts are, and that's at 44 and 55. So if you come over to the GDXJ chart, 44 and 55 is up here. Perfect. So this is the range that we've essentially created for ourselves, visualized on the chart. So what's happening here and what do we want to happen? So price is currently within the range and we want price to stay within the range. Now, if price is within this range at the point of expiration, which is 36 days out in time, then we will keep 100% of the premium that we collect up front. Now, what is the premium that we collect up front? That is this number here, 1.2. That is $1.20 per share, and there's 100 shares per contract. So that's $120, as can be seen here by the max profit. So if GDXJ, if the price of GDXJ stays within this range at expiration, then we will keep all $120. Now, in order to open this position, our broker is going to require $1,724 in buying power. If 1.7k is too much for your portfolio, then by all means, you can just buy another contract a little bit further out. So, for example, on the call side, we've got a short strike at 55. We can just buy another contract at the 60 strike here, $5 wide, and then we can just do the exact same thing on the put side. And now we've created a $5 wide spread on either side. And as you can see below, our buying power has now been reduced massively, and that's because we no longer have an unlimited loss potential. And the reason for that is because our loss is now limited by the contracts that we've bought. It's $5 wide, so we can only lose a maximum of $5 per share, and we're collecting $1 up front. So $5 minus $1, that's $4. Hence why we have a max loss of $400 here. So that's how you can find and manipulate positions. There is also one other thing that you do need to know, and that is the sizing of your positions, because it doesn't matter what you know and what you do. If your sizing is wrong, eventually it won't end well for you. So what we've got is a position sizing template that's free for everybody to use and get a copy of. The way it works is you enter in the size of your portfolio. Let's say if it's $25,000. Below that, you can then enter in what the current VIX level is. Say if it's 14.2. Below, everything then will be automatically calculated for you, and all you need to do at this point is use the information here to form the backbone of your portfolio, and you'll be just fine. If you want to get a copy of this, click the link in the description and then head over to free position sizing template, and it will take you to where you need to go. If you do want to get involved on the positions that we're placing, and you want to make money with us, and you want to learn in much more detail, again, click the link in the description, click on EDS Premium, get yourself signed up. Inside, you will have access to our portfolio, so you can copy our positions live and all adjustments as well. There's also a full course, so you don't need to know anything prior to joining. We will teach you everything. It's a private community, so you can speak with myself and other like-minded individuals. And there's also a 100% money back guarantee. So once you've studied our full course and followed our trades for 6 months and haven't seen results, then we'll work with you for free until you do, or you can request a full refund. So it's completely risk-free. It's £1 a month to join, and the price will be increasing. So get in while you can, while the price is still cheap. Once you're in, you don't need to worry about any future price increases. Your price is locked in forever. And with that being said, I'll see you guys on the inside.